human capital, clusters of activity, and deeper societal attitudes towards risk aversion and risk attitude remain very important. An example in this respect, which is closer to the banking sector, is the progress to create a more integrated and liquid market for securitized products. The introduction in 2019 of the securitization regulation, as well as the simple, transparent, and standardized framework, which has a preferential prudential treatment under the capital requirement regulation, represented an important step forward. However, the framework has not produced the expected results. The work to enhance the securitization framework continues to be ongoing. We at the ABA have published, together with the other ISAs, in December of 2022, a review of the prudential framework for securitization to try to improve its efficiency and risk sensitivities. It is acknowledged that the lack of revival of the US securitization market should be found in the interplay between demand and supply conditions, and that no simple regulatory solution is identifiable. Only a holistic and comprehensive review of the current framework and the functionings of the market could have the hoped effects. In the meantime, the EU securitization market is a fraction of what it was. Securitization's volume amounted to 2 trillion euros in 2010 and was at around 500 billion in 2022, so 25% of the size than in 2010. In contrast, the outstanding volumes of securitization in the US in 2022 were well above the levels prior to the global financial crisis. A third aspect, from my point of view, relates to the lessons that can be learned from the persistence of fragmentation in the banking union. As I mentioned before, financial stability concerns by member states and possible mutualization of risks in cases of bank failures and resolution have been at the core of the reluctance to further progress towards European integration in the banking sector. Here, I'm more optimistic for the prospects for European integration in capital markets. The economies of scale in capital market activity, the rationale for concentration of market activity in a single entity or location, to create deep liquidity pools, to create a specialized knowledge in financial markets is clear to me. It is also clear that Europe has too many, I would say, national markets in a number of financial products, call it the equity, derivatives, or fixed income, all of them too small. The case for consolidation and specialization is clear. At the same time, the concerns that concentration may impact financial stability at the level of a member state, or possible risks for mutualization in case of failure, which are typical concerns within the context of the banking union, I think they're much, much less relevant or even irrelevant in the context of capital markets. A fourth lesson that I would like to extract has to do with the creation of pan-European financial firms. The creation of the banking union has led to some consolidation of banking services across the EU. Most of those consolidations have taken place along national borders. However, as I mentioned before, cross-border consolidation of banking groups has been quite limited, despite the creation of the single rule book and the creation of single supervision at the European level. Banks executives constantly argue that the economics for cross-border consolidation do not currently exist in the EU. There are, however, certain segments of banking activity where cross-border provision of services by consolidated groups has been increasing in the last decade. This is happening precisely in those areas more closely related to capital market activity and corporate banking, in investment banking, in trading, in corporate lending, and similar activities. In this aspect, I see potential for the creation of larger pan-European financial players in the capital markets if the conditions are favorable. A fifth reflection has to do with the effective provision of cross-border retail financial services in the EU that has been mentioned already as well by Aleksandra. The experience from the establishment of the banking union shows that progress here is difficult. Most of the retail lending and banking services provided to EU citizens and SMEs remain within national borders. Cross-border provision of such services, with the notable exception of payments, remains very low. A large number of well-identified differences across member states of very different nature, call it insolvency regulations, fiscal treatment, cultural attitudes towards risk, tradition, and competitive dynamics, made the expectations of developing truly European products through sequential regulatory harmonization and supervisory convergence very difficult from my point of view. Here, a truly big bang approach will be needed if progress needs to be made in this or wants to be made in this front. Let me conclude. I do believe that deeper capital markets in Europe will help us in addressing some of our challenges. I think the experience from banking integration can help us in better achieving this goal. On the negative side, I fear that we lack the sense of urgency and existential crisis to make progress. We need to be convinced that deeper capital markets are not just nice to have or good for the financial sector. They are existential for the future of the Union and for the well-being of our citizens. On the positive side, financial stability concerns on financial stability that have slowed integration, on the positive side, concerns on financial stability that have a slowed integration within the banking union are much less significant in capital markets, while the economic benefits for the specialization and economies of scale are much larger in capital markets. This should drive faster integration if the conditions prove adequate in that area. Thank you again very much for your attention.
Thank you very much, Mr. Campa, for your insights. Before delving into the topic a bit more deeply with the first panel, could I ask Ms. Sirpa Pietikäinen to have a short introduction of the first panel?
Well, welcome to the next panel to discuss how retail investor markets can really boost up European economic stability and growth. It's either very difficult or easy. I don't know how to take the approach to continue after you, because I think that you summarized the overall landscape pretty well, and I couldn't agree more with you. So in that sense, I could comment that I do not have anything to add, anything to say, so please, the panel, come in. But then again, if I look the other perspective, and this is the political perspective on this challenge, is that we are in enormous challenges. It's not only the sluggish growth, climate change, that is going to probably hit hard the financial markets much faster than what we see nowadays. I'm sort of having the gloomy pictures of from 10 to 20 years that we are going to have the impact if we do not sort of speed up the curve of combating climate change and resource efficiency. So, but that is another story, but I just need to underline it because I think that the sustainable finance is the key, what needs to happen, because money runs the world, as you know. And then if we can set up that kind of a guiding principles in investments, in lending, in interpretation of significant harm, and on preferential treatment, for example, investments on sustainable buildings, that at least can sort of pave or soften the way for us. But then there's the autocratic populism. And while we are speaking here about the investor trust, retail investor trust, we are talking about capital markets union, retail market union, investment union, banking union. You probably can guess what the people on the streets and what the populists and member states in increasing numbers are saying. They are saying, we do better without the Europe. They think that all Brussels, Bruges, Paris, Nice, and whatever the location in Europe can do better only by themselves. And there where you go to a municipality level, we all understand that one city or region can't compete in the global markets or deal with banking supervision or adequate capitals or investments or anything basically. So the member states is not against the individual municipality. But then when you get on the EU level, it changes. The EU is the black dragon you need to fight against. And why I wanted to talk about this, it links directly to retail investor trust and politicians' willingness to find compromises and work together. So this is kind of an appeal to you also, that when you talk with your friends, that matter your enemies and competitors and people you hardly know, remind them to vote. We can't sort of change the minds of the populists They are going to vote anyway, and they are going to lift their middle finger in the voting booth. But there are a lot of people that are just plainly ignorant about the EU. They think EU is, well, I don't know, but it's probably okay. I can't sort of say anything new, and there's no point of voting. These are the people we should be recruiting to vote. Then about the challenges. Politically, it is of course the big question how the next parliament is going to look like. But then I'll move to retail markets, okay? Europe is pretty bank dependent, as we know. And we are very poor on capital, venture capital, and different kind of a fund structure. And because of this way how we are organized, we are very poor on retail investor trust, pan-European retail investors, and the appetite to move from deposits to investing. And sort of I can understand, because if you do not have the European supervision, I'm not so sure that I would like to put all of my pension funds to Greece, Malta, Cyprus, or that matter any other very reliable good investor in some parts of the Europe I am not that well aware, and I might have some stereotypes. Then how do you think we could create a trustworthy retail investor? So the first point is the supervision. The second point is, you are all probably are well aware, we are debating the EDIS in European Parliament and the deposit guarantee scheme. But do we have that kind of a guarantee scheme and understanding of retail investors? If they doubt to invest in Portugal or that matter Finland, can they rely that their rights are the same, they are properly protected, and in case there's some issues, they can be compensated? And this is very difficult and hard part, like the common shared liability in the EDIS side. And I think that in the retail investor strategy, we did take some steps forward, but no, we did not take adequate steps. We would need to have a common consumer protection, that is retail investor protection scheme, and that hopefully is on the next Parliament's agenda and Commission's agenda. And we do need a better information, harmonized information about the investment products and the environmental matters also. And we need that matter, a better harmonization still about the financial regulation, so that you do not end up creating that kind of a black holes. Nowadays, when you first see an animal, then you define what it is and then you regulate it. But to me, if it sounds like a bank, it walks like a bank, and it smells like a bank, it's bank, whatever you call it. And it's a derivate, whatever betting instrument you call it, if it's a derivate. And why it is so difficult to go for that kind of an inlined regulation where you cover all upcoming products too? If it does these features, be it peer-to-peer, be it whatever new type of the funding element, be it online, virtual, based somewhere else, it is either banking, it is investment, it is lending, or it is a security. And then you cover it all. And that's why I think that when we are talking a lot of this kind of a administrative burden and cutting it down, this could be one perfect example. And by the way, when you start that, hopefully, you could start by harmonizing the sustainable finance regulation. We are perfect in politics, making political compromises each and every time differently in each and every piece of legislation. What you report, what is the threshold, what substances there are, And that's why you, of course, add the reporting, but you also diminish the information and the clarity for retail investors. Could you just review it with that kind of a mandate for the Commission without changing the content and the spirit of the regulation to harmonize the details so that you could have one reporting platform and you connect that to the information side for the retail investors so that both the environmental, ESG, and other information, the profitability and the risks and the keys can be found in the same place. So these are just some thinkings about what we can do in this side. But I think that it would be now interesting to go into the discussion and the panel and to start to dwell a bit deeper in the matters of what actually we can do to empower the retail investors and to increase the participation in capital markets. And I don't want to take more time, but there are subjects like how you can use the financial sector as responsible shareholder in the companies, push for the environmental and climate transition, and actually empower people and the retail investors and the clients by that way too. Thank you.
Thank you very much, Sirpa. Guillaume, could I ask you to come up on stage with your panelists for the first panel?
Good afternoon. So we are only 20 minutes late, so we'll proceed. Thanks so much to José Manuel Campa and to Sirpa, and especially Sirpa, to have given us the big picture. And so I did not plan to say that, but yes, please tell your relatives to vote and tell them to tell their relatives to vote, and etc. This is very important. I'm very happy to moderate the panel. I will not present the panelists because you have everything in this very nice brochure. It's all, as you know, extremely talented, experienced VIPs, and so we are very happy that they participate. To set the scene, I just wanted to show you a few graphs because José Manuel Campa has left, but he said, I like this parallel between the banking union and the CMU. I should say SIU, I have to get trained to that, Savings and Investments Union. The banking union stems, like always, as he said, remember Jean Monnet, from the 2008 crisis. But I think today we are also in a crisis, and I'm going to show you a few figures. So, economically, when you look at GDP, in fact, I will compare to the US, but this, we could do the same with Asia. I just didn't have time to gather all the right figures. So globally, economically, there is a problem. You heard José Manuel Campa on the projections for the next 5 years. Not good, especially relatively to other regions like Asia and the US. Remember, the Capital Market Union was about developing European capital markets. Unfortunately, you see the reverse. We were about, at the start of the CMU, we were about 1/4 of the US market cap. Today we are about 1/6, and you see the trend is not positive. Why? Well, first, if you look at prices of stocks, we have the US stocks, the first 500 stocks compared to the first 600 European stocks that have increased about almost 3 times as much as European stocks. So, no surprise, the price-earning ratio gap has widened. And why is that? Many reasons, but one key reason is my last graph, is that when you look at the earnings per share, still the same, from the first 600 European companies, listed companies, and the first Americans, you can see that the earnings of US-listed companies have grown 4 times more than the European ones. And that is a big problem because it means European companies have less money, to be blunt, than the US ones. And the problem is money is needed, especially, for example, for the environmental and sustainability transition, but also, may I remind you that Europe is really close to war today. We have gained 70 years of peace thanks to the European Union, so tell that to your relatives as well. The European Union does have advantage, but as you know, the war is very close now to our doors. So, as you know, EU governments have less and less money, and some have no money anymore. So money has to come from somewhere. Last statistic I would like to give you that is not on the graph is currently, so you've seen the US market cap, it's 62% of the world. It's 90% of settlements to indemnify investor abuse. So talking about investor trust and investor protection, the far west is not west, is here, because you see what remains for non-US abused investors. So I will switch now to the panel. This panel will be focusing on the retail investment aspects, focusing mostly, because I'm sure Marcel would like to talk a bit more broadly, on the retail investment aspects of the Capital Market Union. Savings and Investments Union, I like this term very much. It refers to the real economy, the savers, investors on the one side, on the offer side of capital, and the enterprises, the businesses who need investments on the demand side. And the second panel will of course focus on all the other aspects of this Savings and Investments Union, just getting trained. And so for this, I will ask questions driven from our manifesto that was published last January, that you have. And so there are key proposals there. So I will ask the panelists what they think about them. And actually, what is good is that many of them have inspired, and that's very encouraging, the Eurogroup report of last March. And today, the Letta report of Enrico Letta. So, without further talking at here, I might try to join the, to get closer to you. And I would like first to give the floor to Marcel Haag. Thank you, Marcel, for being here and tell us more about what is the assessment you make today. I know it's not an easy time for the Commission because it's going to enter into a new cycle, but what's your assessment and maybe a bit forward-looking on the what you still call the Capital Market Union, I think?
Yeah, thank you very much, Guillaume, and good afternoon. It's good to see a lot of familiar faces in the audience. I pick it up where José Manuel Campa left it when he said the Capital Markets Union is not new. Indeed, it is not new. It's been decades now that we're trying to develop an internal market for capital in the EU, and it's only 15 years that we call this effort a Capital Markets Union. And at the time, the reason was that it was thought that calling it a union would give that endeavor the significance and importance that it certainly deserves, and also put it at par with the banking union. Since we have worked on two action plans, and the Commission has delivered under this mandate all the initiatives that were foreseen under these action plans. Many of the initiatives have been adopted by the co-legislators. The European Single Access Point, the Consolidated Tape, the Listing Act, to name just a few. And then there are still some outstanding issues on which we are working. The retail investor strategy, and I'm sure that we will have the opportunity to come back on that, but also the insolvency proposal, and a proposal on the simplification of the withholding tax return. We are still trying to make as much progress with the co-legislators as we can under this mandate. So we're not only looking forward at the next mandate, but we are still trying to do as much of the unfinished business, and trying to get as much done as we can. And then, of course, and I think that has also become clear, the nature of the Capital Markets Union, and maybe we rename it, is such that you can't compare it to the banking union in the respect that there are not a few big ticket items that you can tick off and then you can say it's done. The Capital Markets Union is a continuous endeavor. There is no finishing line, but we have to go many steps to get there, and we are committed to continue on this path towards completing and improving the Capital Markets Union, make our markets more attractive for investors and businesses. Now, there is a number of reports that are now being published, and the letter report today. There will be a number of other reports still coming. The report by Mario Draghi on European competitiveness. But then there are also reports that are being prepared at national level. There's a Dutch report. There will be the report by Christian Noyer coming out, I believe, sometime next week. So we will have a number of important contributions as an input. We had the Eurogroup statement. The European Council is looking at the issue. We have now a significant attention politically for the Capital Markets Union, which was not the case in the past. We think that this is necessary because the Capital Markets Union is a whole of government challenge. It is not something that finance ministers can and the corresponding parts of the Commission can deliver on their own. It is something that entire governments and the Commission as a whole have to deliver. For instance, a number of the proposals that we made under the second action plan are proposals for which DG Just has the lead and which are discussed by justice ministers and not by finance ministers. So we're very happy that it's now the leaders that are taking charge of the Capital Markets Union file, because that is where this file really belongs. Now, we are currently waiting for all the input, trying to digest it, to be able to develop our own position, our own views, but certainly beyond finishing what we have started under this mandate, there are already a few items that I think where a consensus is emerging that they need to be looked at under the next mandate, and I think here Enrico Letta's report has is also converging with our views. But let me mention a few files. Securitization is something that we think will have to be looked at again under the next mandate. Then there is the issue of supervision, where we see that there are a lot of sometimes not so new ideas being floated, but we think that it is important to have another look at those ideas, maybe with a fresh pair of eyes, and certainly calmly and with a bit of recul. So we are willing to look at this with a very open mind and see what can be done in this field. And then there is the issue of long-term investment that plays an important role in the Letta report. And I would say long-term investment / pensions. It is a sensitive issue. It is something that we will not be able to deliver at the European level alone, because tax incentives will play a very important role for making a long-term investment instrument or several more attractive. So we will be looking into ways to increase retail participation and the footprint of long-term funding instruments in capital markets, which could then also be used as a pension tool. Those are some of the things that we want to be looking at. Other than that, we are following the discussion, and I'm also looking forward to the debate this afternoon.
Thank you very much, Marcel, and don't just follow, but intervene as you wish. In terms of consensual themes, as you said, securitization, supervision, I will leave it to my fellow moderator in a moment to talk about it. But of course, long-term investment, we'll talk about it. So let me go straight to one of the first key proposals we made in our manifesto regarding capital market union, savings and investment union, is to provide access to independent advice, or at least to better value for money. Why? Because it's the #1 reason why today EU retail investors are not accessing simple, cost-efficient capital market instruments such as listed index funds, listed equities, listed bonds. In fact, the Eurogroup says the same thing. He says, provide easy access to simple, transparent, and low-cost retail investment products with appropriate risk-return profiles. So, okay, so I will not go deep into independent investment advice. This is not one of the consensual themes you were listing, but about one that may have more luck, which is the value for money. And I would like, in fact, Enrico Letta also alluded to that, because he said we need, the key objective is to appeal to savers, to attract savers within the EU and outside. So as you can imagine, and you've seen what has been going on in the US, yes, investors would be appealed if there is a decent perspective of a good risk-return profile. So first, maybe a question to Fausto from EIOPA. First, I wanted to know if you told Mr. Letta, who seems to focus very much on ESMA, that EIOPA actually supervises 70% of all packaged retail investment products, or maybe he did not hear you. No, that's a smiling question. My more substantive question is on value for money. Of course, that is part of the retail investor strategy proposal that is currently at the Parliament and the Council, but it has been also a lot of work done by ESMA and EIOPA, and I would like to get your perspective, especially you seem to be using or going towards using, like in fact the French supervisor, ECPR, to peer group benchmarks on returns and costs. What about not using actual capital market benchmarks like the FCA, when it was in the European Union, did this value assessment and checked if the providers were in line with their objectives or not, and objectives benchmarks on the capital market performances. So, Fausto, value for money, please.
Thanks a lot, Guillaume. First of all, let me say that I'm very happy that the letter report mentioned pension, insurance key role in enhancing capital market. The sector has a lot of money to invest, and we need to make sure that this is helping the capital market union in general. The pension is an issue that is quite important, and I'm happy that the mentioning of these two key important points are there. I'm also happy that there is a reference, because I went quite quickly this morning through the report, but there is also a reference to enhancing the supervision in insurance sector, because I still believe that we, under our mandate in terms of supervisory convergence, EIOPA made a lot of, we are proud of our effort, but still there is maybe in this completely changing environment, there is still maybe some opportunity, I don't know if it works, some further, let's say, efficiency that we can gain if we work together between central authority in Europe and the national authority, even more than what is happening today. There is a reference to it. Let's see if it's developed. Why this is important? Because if we speak about single market, and you mentioned already, there is a question of trust. Under our analysis, 1/3 of people that we interviewed, their product does not give enough value for money. 1/3 of the European citizen, which is a question of important question of trust that we need to work on. That's why already time ago, before the proposal from the Commission, we started to develop this idea of value for money. How the principle is quite basic. We just need to offer the people some product which offer a value, which have cost and return that are proportionate to the needs of the people. Basically, so the idea is quite basic. The cost needs to be proportionate and reasonable. Proportionate to the guarantees offered, to the return offered, to the service offered, and reasonable in terms of expenses from the provider that offer the product. So the idea is just basic. Everybody, even my grandmother, can understand it. How to make it work is a bit more difficult, and that's why we developed a methodological paper already time ago. Now we are working on a methodology to have the benchmark, to cluster product, to make the comparison meaningful so that you may have, when talking among supervisors, you may have a reference when a product is an outlier and you need to intervene to ask the provider of this product to change the product or even to take off the market. And this is something that we are already doing since a while. It's not, even though it's not maybe so publicly known because there is not always a public announcement, but we compare products from different players. We speak about among us in the supervisory forum. We take action. Sometimes we are successful, sometimes less. And this is why there is a need to enhance our supervisory capacity. But it's already there, it's already there. Now, the Commission proposal adds on top of what we are already developing even more, and we are super happy. We follow the negotiation. Of course, depending on the negotiation, we will also adjust. But this is something that we are already doing without, let's say, underestimating the difficulty on this cluster comparison. But it's something that we are doing is already there, and we are proud to do it. On top of it, why we started? Because when we started to develop cost and past performances comparison, we saw a number of differences also across member states. We also saw sometimes justified, but sometimes less justified difference in terms of cross-border product, how much they cost. Generally, they cost more. There are good reasons, but we want to have a single market, yes, then we need to address it. And if you see the last report on cost and past performance, the costs are on average 2%, 2.1%, but with a lot of variety between 0.8 and 4.9 when it comes to unit-linked products. So this is something that in a single market, if we want to develop it, we need to try to address. And this is why we start working on the concept, and we will continue.
Thank you, Fausto. So EIOPA has been working a long time. National competent authorities also are working. For example, the French ACPR has already started some work with some similarities with what EIOPA is doing. But maybe let me ask an NCA and Annemie, what do you think about this value for money project?
Thank you very much, Guillaume. But before going into that, I would like to briefly, if you allow me, come back on the why do retail investors not access simple products. I think there is another consideration, which is, I'm not sure, I'm very happy to hear, I'm very happy that this topic is taken at the highest level and that leaders are in charge of it. But I'm not sure whether there is really a EU-wide societal consensus about the value of investing in equity. Is there an EU-wide consensus about the importance of the role of capital markets? There is a consensus, yes, among us, but is there a consensus at the bottom? A few weeks ago, I talked with the head of listing of Nasdaq Nordic, and he said, yeah, in Sweden, for example, every household is invested in equity markets through his pension fund, and measures the importance of developing capital markets. So there is a common consensus and an engagement bottom up. There is a demand. So just briefly wanted to say that. And I think also there is a very important bias with retail investors for local products. If we take the Belgian example, for example, we have an open economy. We have more than 5,000 authorized or registered collective investment funds. So that's the pan-European investment instrument par excellence. And 87% of this product offering are foreign products, and 13% are Belgian products, but the 13% Belgian products account for 60% of the investments. So there is a bias, a preference for local products, and a preference for the products of the local banker, the home banker. Also, evidence seems to show that commercial bank affiliated products underperform non-affiliated products. But despite that, the affiliated products have a large market share. So there is a bias. So now coming to value for money, I think the value for money approach can help break the bias, or should help break the home bias. And it has long been a major concern at European level, ESMA, EIOPA, also at national level, because what we see is, despite the efforts to really simplify information and information about the costs and the impact of cost on the performance of products, despite all efforts to simplify, notably in the key investor document, we see that investors really still struggle to distinguish a product with a less predictable outcome from a product that guarantees a minimum positive outcome, from a product that guarantees that you get your money back. So it remains very difficult. And that is why supervisory authorities, ESMA, EIOPA, see it as their priority to develop instruments to enable investors to position the products they are offered, and to better understand the impact of costs on return. And we at the FSMA did so for UCITS, so for the collective investment schemes. We made a presentation, we posted it on our website, and it's really an instrument, first, allowing investors to understand the structures of costs and the impact on return, and second, to position the product they are offered with regard to an average, a Belgian average. We did so for structured notes, and by the way, within the review, when we review the product oversight and governance process for structured notes, we take as a reference also capital markets performance. So we really challenge the value for money of the notes on the basis of what you just said, the reference to the capital markets. We developed these instruments for insurance products where we compare premium collection and claims payments, payouts ratios. And we're in the process of doing so for second pillar pension products. So all this to say that we are a strong believer of empowering investors through these instruments. But we should also acknowledge, I think, the limits of the exercise. We will be able to identify outliers. When we talk about benchmarks, we talk about identifying outliers. And we succeed in identifying outliers and in persuading them to suspend offering of a product or to amend the characteristics of a product. But there I agree with you, Fausto. It's persuasion. So that is any effort to really enhance and force powers to enforce would be very welcome. But it's about outliers, and our action will end at the boundaries of reasonableness. So that we should acknowledge. And therefore, and that's the last element I would like to mention, an idea we had at the FSMA was, and an idea that I find also, I think, in the letter report is, why not make life much more easier for investors and identify ourselves cost-efficient products and label them? That would make life much more easy. ETFs are seen as the prototype of low barrier, simple and cost-efficient investment products, but to date, I think ETFs channel EU savings to the US. That's also something that is mentioned in the report, I think. So I think it would be worthwhile reflecting on an EU ETF scheme. And that would be a cost-efficient labeled product, and that addresses the limits of the value for money approach.
Thank you very much. Very interesting idea on the label and on these ETFs that you suppose are channeling most funds to the US. I have a proposal to make and to test with the panel. Just 1 minute more on the value for money. It reminds me that one of the key proposals of the retail investor strategy proposal of the European Commission and Finance to have key investment product disclosures. So I'm referring to the package products KID, but also to the summary prospectus for securities. That is simple, short, intelligible, relevant, and digitally readable. And my question may be first our panelists representing individual investors. Ben, we still are looking for this key information disclosure where we have the actual long-term past performance, the performance of the benchmark chosen by the provider, and the actual annual costs as a percentage of assets. What do you think about that, Ben? And then maybe I will ask a regulator as well.
Thank you for the question. I'll start by saying I'm quite happy today simply already to be here, because at the EU, for some reason, individual investors have a seat at the table, while in Belgium that is not always the case. And that's one of the things I wanted to mention. To engage the individual investor, you need to motivate him and make him happy to invest. And the general framing of investing in this country, and I think as this is Brussels, the capital of the EU, should be a leading example, and it is not the case. And this is for politicians as well as for the press. It seems that we are the enemy, and we feel we are not. So again, happy to be here today. I was also very happy this morning with the report by Mr. Letta, because it very much aligns with everything that Better Finance and we at a more local level are saying. And I'm also very much in favor of this new potential name for the EMU, because if you remember that CIU, it sounds a bit like that sound that Ronaldo makes every time he scores. That would be a very easy way to get young people interested in what we are doing. As far as concerns the KID, I wanted to thank Ms. Pietikäinen for her advice to simplify. We do lack financial education, of course, so keeping it simple would be a helpful approach to get individual investors more attuned to what these products actually are. If you read the presentation of the panelists, you will see that I used to work for Morningstar, where we investigate the easy access to all these products by the retail market, and Europe and Belgium especially do not score very high on that. Easy access, well, it goes together with the access to good advice, I would say. We have to go through the bank, while in markets such as the United States, you can go straight to the asset manager or straight to the market, which we cannot here. So it sort of forces us to trust the advisors, whereby the advisors complain, and this is maybe more directed to FSMA, that they cannot communicate to the retail advisor in a way that they would like to, because you cannot focus on performance, you cannot focus on risk, you cannot focus on, but these are things that we do really understand. So while I do agree that we should regulate how you present your performance and your risk, I would be a strong proponent, I would say, to make this possible again. We do not get presentations by the institutional providers of products simply because they say we are not allowed to say a lot to individual investors, so it's not worth it to come there. We can only do a little bit of marketing. We cannot go down into the product. So that would be my advice. As far as value for money is concerned, I would start by saying cheap isn't always good. which we have learned, but the regulatory constraints would help us to communicate to retail in a better way. That said, are there other things that made me happy today? We said we want to activate individual savings and investments for the EU. Well, to do that, in the report is also speech of oblique strategies. They didn't call them that way, but we find every day that it is very hard to convince people in the street to invest. They're afraid, they don't know what it is. So oblique strategies, behavioral finance, I would maybe promote a behavioral unit in the European Union to help specify the communication toward the target audience. And that may mean not talking directly about investment, but talking about the benefits indeed. And again, happy to see that the benefits for Europe are really, in the end, also benefits for the individual investor. We would be happy to invest in Europe if we were more aware maybe of how it benefits ourselves. I think that's the short of it.
Very comprehensive reply. Thank you, Ben. Maybe EIOPA, you would like also, Fausto, to say a word on the key information disclosure?
Yeah, the key information disclosure is important, but that is why we started to work on the value for money, actually, because we understood already time ago that disclosure, transparency is the basic, basically. You need to have it, and there are for sure ways to improve it, and we are happy that in the risk proposal there are actually good proposals. For example, in the insurance sector, we get rid of this overlap between Solvency II and other pieces of legislation when it comes to how to inform possible investor. But we don't need to and I'm also in favor of disclosing the past performances, provided that there are clear indications that past does not always mean that you will get
that holds also for future performance exactly. Disclosure, even more so, I think. Huh?
But it's we don't need to rely only on disclosure. This is our intimate strong belief, because we know that consumers do not always read everything, even when it's simple and it's layered, even when it's super easy. They tend to listen to their advisor, which is also a good thing if the advisor is a good one. So we need to really provide information after having checked in terms of consumer test also what is concretely happening. The famous behavioral science tell us what concretely happens with people. So it's important, but let's also provide the market with good quality value for money product. This is, if we achieve this, it's already a lot.
Thank you. Before we move on, just let me state that for better finance, we still would like to know how much money a product has made before investing in it, and actually what amount of money it has made, because we are in savings and investments, not donations. Huh? So the second key proposal of better finance was, but we started to talk about it, to facilitate access to simple, cost-efficient, and pan-European encouraging. Maybe I change a bit the order, because I'd like that we discussed at the prep call, because I'd like to rebound on what Annemie was saying about labeling, cost-efficient product. And you mentioned ETFs, but you said there is a problem, is that it could be more a channel to export our savings to the US. In fact, as a retail investor, and I want to check it maybe in fact with a market expert, Benoit, but I have been working in the US, and I've been working in Europe. And in the US, it's very simple. I'm a retail investor, so it's not a full-time job, so I want a simple product. I invest in the total stock market index fund, and I'm directly exposed to 3,700 US stocks, so of course, including small and mid caps. And by the way, that's the biggest equity fund in the world, 1.5 trillion. In Europe, I don't have this product. The large index fund on European stock is based on the stock 600, so it misses a lot of mid caps and misses all small caps. And it has a very important advantage for retail investors because that gives you maximum diversification, including on the future, unicorns of the world, on innovative companies, etc. But also for the European economy because it is the natural exit for private equity, and it should be developed. And retail investors are already participating more, relatively speaking, in the small and mid-cap market, both secondary and primary. I think Euronext will be able to confirm, but you can ask Nasdaq as well. And so I have been always calling for this, why not? And to reassure you and Enrico Letta, why not ask European players, ETF providers, to build such an index fund? There are other indices provided by index providers than the stock 600. So first, I would like to get the feedback and the impressions of Benoit, please.
Thank you, Guillaume. Yeah, a few words on this one. Maybe just one idea on the value for money and the attention on the costs. In our perspective, you have to be careful with that one because if you put a bit too much emphasis on that one, you could end up in challenging positions whereby if you only focus on the costs, basically you will advantage products which are not listed today, which are potentially less transparent, where you could have conflicts of interest. And where basically you have the listed products which are more expensive but more transparent, and they have more important disclosure duties. So we question that one on asking ourselves, okay, do we go into the right direction with that one? And the same for the key IDs, because you have key IDs for listed products. That's using a lot of energy and a lot of emphasis within the issuers, but you have thousands, hundreds of thousands of these products which are listed, very transparent, and do you need also to issue key IDs for these ones, liquidity. You indeed have many funds that attract, that focus on US stocks. And basically, they can, with the ETFs, with passive investment, you have low costs, and that comes to the detriment of the small and mid caps which are listed here, because we see that these small and mid caps, their liquidity is drying out. So the support must also make sure that we have specific measures to support the liquidity of the smaller and mid caps. Smaller and mid caps today, well, it's up to 30 to 40% of the liquidity that comes from retail investors. So it's becoming lesser and lesser, and so that also implies that these companies have less attractiveness for institutional investors, which has an impact on the valuation, and which has also an impact on their cost of capital and their possibility to raise additional funds. So the focus must also be on these smaller caps. If you look at the exchange in Brussels, 50 years ago we had between 300 and 350 listed companies for a total market cap of 7 billion euros. Today it's 120 listed companies for 336 billion euros of total market cap. So you see that there is a movement, which is not only in Belgium, but you see it everywhere in the world, that companies tend to be larger and larger when they are listed, but you still have hidden gems among the small and mid caps. We see that, for instance, we have our blue chip indexes, the BEL 20, but we have the BEL Mid for the mid caps. This index is outperforming the CAC 40, the IX 25 since many years because we have hidden gems there, but these companies tend to have more difficulties to attract institutional investors and to attract basically the attention of institutional investors that will help them to finance their next steps. And today I had lunch with a board member of a listed company, and she explained to me that they just had a capital raise a few months ago, and they had many questions on the best way to raise capital. And finally, they opted for an ABB because basically there was no other choice. They could have done a rights issue, but the rights issue is much more expensive, takes much more time. And yeah, she wondered why it was so much more expensive and why it took so much more time. And then, well, I explained the situation today of the prospectus regulation, but tomorrow, when the Listing Act will be live, all these transactions, up to 30% of the outstanding capital, will be feasible without prospectus, and I think that's a big step forward for all these corporates to basically allow them to raise money much more easily and to mobilize the savings and the investments of the retail investors. Because when retail investors get nice opportunities, they jump on it. In Belgium, we had the state bond that raised 22 billion euros. We saw it also with COVID, where retail investors jumped on securities accounts, and yeah, if we can mobilize this funding to finance the real economy, to finance our SMEs, our champions, our European champions, that would be great. Yeah.
Thank you, Benoit. So I hope you will help us find seed money for this very broad index fund, European domiciled index fund that will invest massively also in mid and small caps. One other way to get simple products is to eliminate the most complex ones, Annemie. I think with the existing regulation, structured products sold to retail investors, that happens a lot in France, for example, that cannot happen in Belgium. Could you give us your view on this? Because that's something, apparently, it is doable even without a change of regulation, European regulation.
Yes, happy to do so. Indeed, you can, to protect investors, to empower them, you can inform, you can create safe product frameworks, but you can also intervene in the product offering itself. And as you might know, that is one of the first things the FSMA did in 2011. That was kind of closing a deal with the sector and edicting a moratorium on the commercialization of overly complex structured financial products. Maybe a word about what triggered these initiatives. It was the fact that structured products, in our view, generally fitted in a push marketing strategies by product manufacturers. And it was kind of a value for money consideration avant la lettre, because the impression was that these products created value for money for the manufacturers, but that they did not necessarily, and it was the concern at the time, not necessarily took the consumer's view. And so the starting point of the moratorium were the FSMA's doubts about the benefit of structuring for the investor and about the ability of a retail investor to really fully understand the characteristics of the products. And the basic philosophy is that you cannot expect from a retail investor to make more than 3 calculations to calculate the return of a product. And these criteria were discussed with the sector at the time. So 3 calculations, and that some strategies are really too difficult to understand correctly. Since the moratorium, we have screened more than 6,500 structured products. And obviously the complexity of the market has been reduced. The moratorium still evolves and is an evolving instrument. The latest initiative we took, and we observed the evolution of the market. What we noticed, for example, very recently, a few years ago, is that product manufacturers use in-house benchmarks to calculate the return of a product. But in-house benchmarks are really opaque. They are not accessible to retail investors. And so that was the last initiative we took. That is within the framework of determining the target market for such products. Product manufacturers should really take into account only very highly skilled retail investors with high financial knowledge. And since then, we really almost observe no in-house benchmarks anymore. So that is an initiative we took to make retail investors move away from these structured products. We simply took the stance that you can have doubts about the added value of structuring. As I said, that is a moratorium agreed upon with the sector. Every Belgian bank subscribed to the moratorium, but every bank is free to leave the moratorium also, which has not been the case up till now.
Thank you very much. We, at Better Finance, we have a lot of sympathy for this thing on the overly complex and impossible to guess what is their performance with highly structured products. And I think the European economy and Mr. Letta and the Eurogroup think also it's not what we need to focus on. I am told that I have to speed up, although the delay was not the responsibility of this panel. So maybe I will, two last questions for the panelists. I will have to skip, unfortunately, very important points on cross-border shareholder engagement and on collective redress, which are very important for us, but two other topics which are extremely important. First, the taxation, especially cross-border, and second, and it's a project you find in the Eurogroup, in Letta report, also in, and I love the name, a non-paper from the French Perm Rep, having a long-term, pan-European long-term investment product. But first, on taxation, just remind you two key proposals from Better Finance. First, even before, as Aleksandra mentioned in her introduction, even before automating and make it simple for the tax refund, to start with, eliminate the double taxation of dividends within the EU between two countries. For example, not you, but Belgium is taxing Belgian dividends at 30%, and for example, French dividend at 40.5%. And that's after getting the withholding tax. For us, that is totally against the spirit of the Treaty of Rome and of the single market. And our second proposal is to tax the real long-term investment income, not the largely fictitious nominal income. I'm very happy to see that Letta report is really focusing on this importance of having tax incentives, especially when you ask people, contrary to their, almost unconscious feeling, to block the money for decades for their retirement, for example. So maybe, I don't know if I should start with the Commission because they have no competencies in taxation, but maybe if you want to say a word, Marcel.
Happy to do so. On withholding tax, I mean, this is really one of the basics of the single market. And, when we talk about home buyers of retail investors, look at how dividends are being taxed, and then, you might be onto one of the key reasons, and this is simply incomprehensible if we want to have a higher retail investor participation in European capital markets. It makes no sense. But you have seen that our faster proposal, which is much more modest than what you're calling for, in what kind of difficulties this is running. At the level of the member states, to try. Now, on the long-term savings product, I think Mr. Letta quite rightly points out that there needs to be a tax element, and if you look around in the member states, the successful products, they always have a tax element. But that, of course, that being said, it's easier to say than to do, because we would need the member states to be on board for that. But we can only hope that. I know that a number of member states are already interested in the development of such a product, being fully aware that there is a tax element that is needed. We can only hope that when we continue the debate and deepen the discussion, that more member states will come around to agree to that conclusion.
Thank you. I will give the floor to the individual investors, but first, as this long-term product, Letta alluded to the PEP, to a workspace product. I know the PEP is dear to the heart, not only of Better Finance, but also of EIOPA. So maybe first Fausto and then Ben, and then if any other wants to react.
We have been working on the PEP for years. That's why we really want this to fly. And unfortunately, this is not yet the case. We are convinced that this is an additional tool to fight against the pension bomb we are facing. And unfortunately, this is the take-up from the provider is not yet there. We only have one product. The reason is actually what you mentioned in terms of tax treatment, for sure, but there is also a need to revise a bit the regulation, because there is a cap on costs that I have been told by many providers can be the limit of this taking up from the provider. I would really... I know that I'm not saying that I agree that the cost cap that was put there is unsustainable from a business perspective. I do believe it's sustainable because it's 1%, if I remember correctly. But there is actually something that we need to address, because if we work on a regulation, we work on a tool to fight against the pension bomb that is coming, and we know that the pension issue has to be faced with the three pillars. One is not enough. We work on the occupational pension, we work then on the second pillar. The state is not in our remit, but we provided the Commission with some good advice on how to enhance the pension dashboard, pension tracking system, to make people aware what they will get the day after they stop working. This is key, because people are not aware, simply. So if the day they become aware is too far away, then they don't have time to save anything. Then it's too late. That's why we work on it. And the PEP can help. And it's a simple, transparent, easy, super clear. Why? Why it does not fly yet? And I think we need to work on it again. We cannot stop working on it till when it will fly.
And Letta agrees. Thanks, Fausto. And Ben?
I just wanted to say, trust Guillaume to find the one thing that makes me less happy. The translation of EU regulation and guidelines to the local level. May I put you all on the spot and simply ask, who of you invest? Simply raise your hand. See, this is why we're in the right room. When debating with local politicians in Belgium, I unfortunately have to say, none of them invest. Can we mandate politicians that they have to invest both in a European product and in a product of their local market, so that they can see the difference and maybe help them understand the importance of reducing all these hurdles?
And it's not only Belgian politicians. I can second your request. Anyone else wants to react before we close, either on the taxation or the long-term saving products?
On the taxation, I can only agree with what was said, and it will reduce the complexity of investing. Because today, I think we spoke about the people in the street who are maybe not really committed towards investing, but if they buy a stock which is from a company which is from another country, they will not understand that they have twice the taxation, and so they will just sell their stocks and take no investment position. So I think this is an obvious one. It's probably a challenging one for the budgets of our states. But on the other hand, it's really important one. If we want to attract all this money towards the SMEs, towards the large caps, we need to find ways to simplify the access to capital, and this one is really an obvious one.
Thank you, Benoit. And one last word for Annemie.
Thank you so much, Guillaume. I just wanted to say...
Last word will be for...
No, my impression is that the regulatory framework is there. We can create lots of products, pan-European products. It is possible. The usage framework is there, the LTIF framework is there, the PEP framework is there, the benchmark regulation is there. So the framework is there, it should be used. And of course, one big element is taxation. I learned that in Sweden they have an investment savings account, which is super easy, transparent, accessible. That would be a nice example. But we really, in my view, need an engagement from all stakeholders. And when Benoit talks about prospectus regulation, and really happy with you that will reduce burden, but we also have investment banks that accompany companies. Very expensive. They do not start when it's not about huge amounts of money. So it's really about the consensus I talked about in the beginning, and I'm not sure we are there yet. So everything that can help will help.
Yeah, thank you. So just to signal to everyone that the Eurogroup has a very great proposal on shareholder engagement, but I have no time to discuss it, so please, I refer to their report. Unfortunately, neither in Eurogroup report or in Neta's report, there's anything on how to tackle collective redress. That might be the topic of another conference. Do we have time for one question? So, from the audience, I mean. Is there any question to this panel before we listen to the boss of Annemie, I mean, the president of FSMA and of IOSCO? No, so we have been crystal clear, and so thank you very much to the panelists.
Thank you very much to all the panelists. In interest of time, we will immediately go on to the speech by Jean-Paul Servais, who could unfortunately not be with us today, but he sent us a video.
Ladies and gentlemen, good afternoon. I am honored to speak to you at today's conference in my capacity as chairman of the Belgium Financial Supervisor, the FSMA, the Financial Services and Market Authority, and as chair of the board of IOSCO. Unfortunately, I could not be there with you in person. As most of you will know, IOSCO, what does it mean? It means that IOSCO is the international standard-setting body for the regulation of financial markets. And as a truly global body, IOSCO unites over 130 authorities regulating, yes, a staggering 95% of financial markets all around the world. As you maybe know, we recently revised our work program for 2024, and it will come as no surprise that our priorities will continue to focus on issues about sustainable finance and greenwashing, crypto asset and artificial intelligence, as well as non-bank financial intermediation and BFI. And with this in mind, I believe IOSCO mandate over investor protection as parallels, yes, ladies and gentlemen, with the mission statement of Better Finance, advocating for the interests of all users of financial services. I should also emphasize that the input of Better Finance on the relevant IOSCO consultation papers is valued, and thanks to Guillaume and his staff and his members for that. Let us first of all start with retail investor protection challenges. What does it mean? It means, for instance, that in today's digital world, fraud patterns are increasingly cross-border and have no jurisdictional boundaries. And more than ever, protecting retail investors has become an international issue and a shared concern between Better Finance, the Belgium FSMA, and IOSCO. In fact, one of the key objectives of the well-known CMU, the Capital Market Union, focuses on facilitating and encouraging the participation of retail investors in the EU capital market through making the EU an even safer place for citizens to invest for the long term. This is the real starting point of all the other side, and not to speak about other things. In March 2023, IOSCO published the final report of our Retail Market Conduct Task Force. And this report, ladies and gentlemen, highlights a wide range of retail trends and sources of potential retail investor harm in an increasingly online environment, where social media is now a major source of information. Increasing digitalization of financial services and greater use of online distribution methods raises new conduct issues and can provide fraudsters with easier and cheaper ways of spreading false communication and information to a wider target audience. Crypto asset scams and greenwashing are two important examples of misconduct arising from global trends and technological development. And I will expand on greenwashing later on. But to respond to these retail market conduct challenges, regulators need to address retail investor harm at its source. They can employ technological tools to eliminate detrimental online marketing channels, identify misconduct early and intervene rapidly. That's what we are doing, for instance, at national level, at the level of FSMA, but many other colleagues all around the world are doing the same job. Supervisors have deployed therefore new and innovative supervisory tools and data analytics to strengthen their supervision, including of influencers. The IOSCO report also highlights the persistent challenges relating supervision and enforcement of cross-border misconduct and the importance of deepening cooperation between jurisdictions in combating financial fraud on a global scale. And this is exactly, ladies and gentlemen, where IOSCO can play a key role, as cross-border cooperation and collaboration between financial regulatory authorities has been a constant and continuing theme for IOSCO. In 2024, IOSCO will therefore continue its work on investor protection through various initiatives. To name a few examples, this includes a consultation report of influencers and on digital engagement practices, but also, of course, our well-known annual World Investor Week, which brings together securities regulator, investor association, and other stakeholders from around the world to promote investor education and protection. Second part of my comment, is it a surprise? Ladies and gentlemen, dear Guillaume, greenwashing. The CMU is also essential to help channeling private funding into the green transition. That's the most important. How to be helpful about channeling private funding, not to discuss about powers and not to discuss about other aspects which are not fundamental. The only real added value about discussion, the current discussion, is to see how can be helpful in order to channel private funding into the green transition, but other challenges relating to the future of the prosperity of the EU. That's the only debate which is for me important. We will not achieve the broader objective society has set itself without the contribution from the private sector. But let us be clear, and everybody knows that at EU level. There is no silver bullet. We must think out of the box, and we must be able to think about maybe a rather long list of different kind of initiatives which can be helpful. But of course, the link between John and Mary in the street and national authorities involved in the implementation of the same rule will be instrumental if we want to be successful in this really important challenge. Capital market and investor-induced market require therefore access to consistent, comparable and reliable data in order to make informed capital allocation decisions. And they need to be able to price sustainability-related risks and opportunities. And of course, the growth of environmental, social and government ESG investing and sustainability-related products has led to several challenges, including the risk of greenwashing. Greenwashing remains a market conduct concern. It poses risk to both integrity protection and market integrity, as it undermines the fundamental trust in sustainable finance. Countering this risk is not an easy task, given that greenwashing can take different forms and can vary in scope and in severity. Greenwashing can also occur throughout the whole investment value chain, and any market participant, from issuer to asset manager to ESG rating and data product providers, can engage in this behavior. And to ensure a healthy global sustainable financial market, there is a need for reliable, consistent and comparable sustainability-related information. Therefore, IOSCO historic endorsement last year in July, released and explained in Brussels, not far from this conference. Last year, IOSCO historic endorsement of the first sustainability disclosure standards of the ISSB, the International Sustainability Standards Board, underscores our commitment to fostering consistent, comparable and reliable system information in the interest of investor and issuer. Now that we have the standards, jurisdiction must consider way in which they will adopt, apply or be informed by those standards, because let us be clear, the national and political legitimacy is at national level or regional level if we think about the EU. And I therefore welcome the European Commission adoption of the SRS, effectively integrating the ISSB standards. And as we must now move towards implementation, IOSCO, of course, will play its role in assisting jurisdiction as they consider implementing the ISSB standard. What's the role of supervisor? It's not a surprise if I'm telling you that supervisors have a key role to play in addressing the risk of greenwashing. And in doing so, supervisors can help foster a culture that will prevent harm and promote investor confidence in sustainable finance. And to bring greater visibility to the role that regulators are playing in addressing greenwashing, IOSCO published a report at the end of last year, 2023, which includes a mapping of the regulatory and supervisory approaches and practices current or planned by regulators in the oversight of asset management, ESG rating and data product provider. This report also includes the challenges and data gaps hindering the implementation of relevant IOSCO recommendations. The market for ESG rating and data product in particular is in phase of rapid growth. And this global market is concentrated about a small number of providers with a global presence alongside a larger number of providers with a more regional focus or offering more specialized services. Additionally, this market remains largely unregulated. However, a few jurisdictions are currently developing mandatory or voluntary policy framework for ESG rating and data product providers on the basis of the well-known 2021 IOSCO recommendation. Earlier this year, I'm sorry to say that, but that's the truth, under Belgian presidency of the Council of the EU, the Council and the European Parliament reached a provisional agreement on a proposal for a regulation on ESG rating activities, which aims to boost investor confidence in sustainable products. Corporate, asset manager, ESG ratings and data product provider, investor, information provider, regulator and policymaker will need to act in concert to combat greenwashing and help build a more reliable ecosystem to ensure trust in sustainable finance market. And this is a journey for the whole financial system. And IOSCO will play a key role, of course, in collaboration with other bodies and stakeholders such as Better Finance as appropriate. With this, ladies and gentlemen, let me thank you for your attention.
So could I ask the panelists for the second panel to come up on stage? And
So, welcome. We're in the last panel, the last round of discussions. I found the discussions today very interesting because Marcel Haag from the Commission mentioned that, it's not enough to develop a capital market initiative at the DG FSMA level. It's not enough to have ministries of finance looking at it. It's not enough for the European Commission to push it if the governments don't act also. And I think some of the other panelists were speaking about getting people involved, making sure they realize money invested in Europe is going to help their economy. It's about a European market. And Nicoletta said it very well. We need to build a European market. We need to work together, to pull together. It needs to be about savings and investments. We need to connect the economy with the financial market. And I think, of course, this panel is going to be very interesting because, how do we do that? How do we link? Some of the panelists will speak a little bit more forward-thinking. Others may look a little bit at what is wrong. And so I think you'll hopefully get a good feeling. What I would like to do, because it's typically, when we're the last panel, we run out of time and there's no room for questions. From time to time, within our discussion, I'll look around and see, is there anybody who would like to ask a question? So think about it and think how you might pose questions to this panel. So with us today, we have Lasse Boom, who's Head of Unit for Economic Policies in the European Parliament Research Service. We have Natasha Cazenave, who's Executive Director for the European Securities and Markets Authority, ESMA. We have Eric de Montgolfier, who's CEO of Invest Europe. Jos Heuvelman, who's a member of the Executive Board of the Dutch Authority on Securities, Autoriteit Financiële Markten. And Nikolai Kozakiewicz, who's President of Nasdaq Copenhagen. So really a panel that is going to look at the market itself. Those of you who are in, and I think this room is in European bubble discussions, you've all read, I'm sure, the Letta report. We were all waiting for it. It is the latest in a long series of reports, blueprints, high priority statements. But this report is different because it's the first time, 5 years ago, I didn't see a report on this single market. I didn't see a report by the Eurogroup. So this to me is a signal that we're finally thinking about linking that economy to the financial market, and that is absolutely crucial. So I'm going to turn, first of all, a little bit on that famous Capital Markets Union, although we should maybe, going forward, say European Savings and Investments Union. The AFM, the Dutch authority, has collaborated with the Nederlandse Bank on a paper analyzing what EU policies are needed. And that was interesting too, because it was at the national level, thinking, what do we need to do, we in the Netherlands, but also at the EU? What measures are essential to link together the economy and capital markets? But I'm going to turn, first of all, to Natasha, because at ESMA, of course, she has been working towards supervisory convergence, and that is a tough world. So let's hear a little bit from Natasha, and then go to Jos, please. Thank you.
Thank you very much, and I'm really happy to be with you today on this very important topic. And as you were saying, Rosina, it's great to hear the interest that is being expressed for these very important topics. So I'm very happy that Jos is here, who can speak to the AFM and the DNB paper, but maybe a few words from ESMA's perspective on what we see. So for the moment, Capital Markets Union, or yes, Savings and Investment Union. First to say, a lot of progress has been achieved, and I think I would like to commend still some of the work that the Commission has done. We tend to always complain of what has not been done, but over the years they have really worked extensively to try and get key milestones across the line. And so just wanted to flag a few: the Listing Act, ESAP, the consolidated tapes. They're not all implemented yet, but they are positive steps in the right direction. Is it enough? No. We still have fragmented markets. They still are not unleashing their full potential. So, okay, the question is, what more can we do? How can we make more? And I really wanted to echo what you were just saying in your introduction, that it's really welcome to hear this renewed momentum and political support. There was a lot of complaints in previous discussions around this theme that that's exactly what was missing, that connection to political support. And so in a changing world that raises new challenges, the sense of urgency that we feel coming through these different statements and reports is I wouldn't say reassuring, but it is important for the support to go forward. So we all know we need these private funds to finance the EU priorities. I like the way Enrico Letta says it's not an objective in itself to have a capital markets union, but it is to be able to serve our ultimate EU priorities, the needs, the transition to sustainable, more sustainable economies, digital transformation. You know, the figures that were given by the Commission are, we need 620 billion euros per year until 2030 for the sustainable transition, 125 billion for the digital transformation. These are massive amounts that the governments themselves, of course, cannot sustain. And so this is really needed for the growth of our economies. But also it's needed because we need to empower European citizens to be able to invest and put their monies to work for their own retirement needs. It was mentioned also in the previous panel, we have what Fausto called the pension bomb coming, so we also need to be mindful of that need for the future. ESMA is working on its own recommendations that will come later, so I will not be able to give you any details today. We're very happy to be able to contribute to this discussion, put some proposals on the table, so that is for another discussion later. What I can say is we're really trying to take that holistic view and try not to limit ourselves to financial regulation, because a lot has been done in financial regulation, and actually if we want to make a real change, we need to look beyond. So I'll just briefly touch upon 3 areas. We need to look at what the investor actually needs. We need to look at what the companies need, and we need to maybe have another look at the regulatory framework. So maybe very briefly, so I give some time to my fellow panelists also to come in. So how do we empower EU citizens to benefit from the markets? We believe we need to look a bit better at what are the opportunities for them to be able to save for their long-term goals? What are the opportunities we need to look at so they can actually participate in wealth creation? We need to consider, as I was saying earlier, beyond financial regulation, tax incentives, what mentioned earlier, but also pension system. How do we unlock that long-term capital to feed into our markets so we have that ability? And what I think is really one of the most important messages from this political momentum we see is that to be successful, we will need a combination of member states and EU-level initiatives. And the conditions seem to be there for that to happen. You need member states' decisions because there's no tax change without a member state willingness. But you also need that EU impetus to get that progress. Of course, you also need financial education, that risk culture that was coming across. So perhaps, as Guillaume was saying, maybe let's look again at the product, at the advice, at the incentives, so that we have the right combination for investors. For firms, funding opportunities, we have fragmentation today. We don't have enough liquidity. We have valuation issues, which means some of our European firms, they just go to the US to get their funding. So how can we solve that? We have excellent experts, so let's see what they tell us. But certainly, maybe we want to have a look at the trading, at the post-trading environment, at interoperability to simplify and create more efficiencies. And finally, of course, as a regulator and supervisor, we will be looking at what can we do from our perspective in our space to try and improve the framework so that in this rapidly changing world, we are equipped to be more responsive, to be more agile, to have the right tools collectively. This is not just the regulators, but so that we are able to actually respond to the needs. So maybe we need to streamline, maybe we need to simplify, maybe we need to have different tools just to be a bit more agile. So happy to open also that discussion in due course.
Thank you, Natasha. And I'm very conscious, you know, that we have 5 panelists and an hour and a quarter to discuss major issues. So forgive us if sometimes we shorten, because, you know, we would love to do more. Jos, your famous paper, AFM and the Nederlandse Bank, what initiatives do you see at the EU level, but maybe also at the Dutch level, that could be done to really build that capital market?
Yes, thank you, Chair. First, quite a few things have been said already by my neighbor, Natasha, but let me try to add a few. First, I think that the focus of the EU policymakers should be on flourishing business and the quality of life of the people in Europe, short-term and long-term. Capital market union is only an instrument. It's not a goal in itself. I think we should keep that in mind when we take measures. Now, Mr. Campa said that there was no crisis. I do not totally agree, actually. I think the pension bump or the pension gap is a crisis. Maybe it is a slow-burning crisis, but it will also take a long time to solve it. And if you are on a long journey, you better start early. I think that's what we are facing here. And so I think pensions is crucial for the quality of life of the people in Europe, but it is also the biggest game changer, potentially, for capital markets union. And pensions, due to their long-term horizon, are very much risk-bearing funds. And for a capital market union, you need capital to start with. Well, pension capital would be very, very suitable for this capital market union. In my country, we started with that 60 years ago. And I think it takes brave politicians to take such decisions as we had in those days. Whether we would do it now, I don't know actually, but then we did. There are several ways to organize a pension system. Of course, the Pillar 1, but I think we all agree Pillar 1 will not do the trick. We need more. We need a funded private pension that can be organized basically in 2 ways. You can organize it in such a way that everyone is on his own. He has to make his own decisions. Then you run into all the issues of cost and trust, complexity that were talked about in the first panel of today. You can also organize it in a collective way, which is what we did 60 years ago. We started with a compulsory system. There was no choice for people. They had to enter that system. But by doing that, you solve all the issues of cost and trust, of complexity, because it has been taken care of by professionals and not by everyone on his own has to make all these kinds of difficult decisions. So one of the key issues is for Europe to build this a funded private pension system. You can do it both ways. If you do it in an individual way, you have a lot of issues. But yes, you also have freedom of choice. You can do it in a collective way, but it is a bit paternalistic. So not everyone will accept that. But for us, it has worked very well. So pensions, for me, are the biggest game changer if you really want to get a capital market union or a savings and investment union. A second issue that's also important has to do with regulation and supervision. I do agree that we should not only look at the negative side. A lot has been achieved already. We are very close to a single rule book. We have made quite a few steps on supervisory convergence, but that will bring you only so far. And if you really want to make the next step, you have to think about centralization of supervision. Now you have to do that in a smart way. We have seen the SSM. I think the SSM was set up to deal with an acute crisis, the banking crisis. It handled that in a very effective way. But was it efficient? I don't know. I think there are some question marks, so we should not simply copy the SSM. We should do some real thinking, make sure that we do not add an extra layer of supervision, but think, okay, what areas are easy to organize centrally? For instance, data collection and data processing, that can easily be done centrally. There are certain sectors where there is a lot of cross-border going on, trading venues, CCPs, CSDs. They may be candidates for centralized supervision. Maybe large asset managers as well, but that would be the next step. I would not, when it comes to retail investment, I would not go for a centralized supervision. Markets are too different. That would be my two main points at this stage.
Thank you very much, Jos. And I'm going to come back to you later a little bit more deeply on supervision. I'm going to turn to Eric and Nikolai to talk a little bit about that pension bomb, about the Nordic example, where you have savings accounts that are are encouraging those discussions about investment, about taking individual interest, about stimulating people to think about their pockets and to think they, and I call this, when I discuss with politicians, I often say to them, you need to build something in people's minds that they, like companies, have a balance sheet with passive and active sides. So if you don't hesitate to take a mortgage loan for 30 years, why can you not think about investing for 30 years? Right? And I think this is something, this consciousness we need to build. So, Eric, I'm going to start with you. The pension bomb and turning people's minds to investing. What is your take on that?
Well, before actually asking people to change their minds, maybe we should change how pension funds function in terms of their investment mandate and the different restrictions that they have to invest in a certain number of asset classes. I've had a discussion with the EIOPA's chair a while ago. We were now actually disagreement in principle, but as usual, the devil lies in the details. Short term, I think that what is really important is that existing European pension funds get a freer rein to invest in European private equity and venture capital funds. Why? Because our fund managers have actually invested 553 billion euros in the last 5 years in European businesses. So we are an essential part of how how businesses are actually financed across Europe. That's an important first topic. Second topic, it happens that we have actually an outperformance in our industry versus public markets, which is extremely significant. When we look at the performance that we generated since inception of those funds, we are between 400 basis points to 950 basis points per annum better performance than typically a benchmark like the MSCI 500. So it's absolutely critical that pension funds can access to the best performing asset classes to benefit their pensioners, simply said. And it happens that in some countries, you are actually prohibited as a pension fund manager to invest in private equity and venture capital. So let's start by the easiest thing we can do. Let's make sure that member states, who are, as you're all aware, responsible for pensions, organize things in a way which allows the fund manager to decide whether it makes sense or not to invest. We're not asking for a certain amount of assets dedicated by obligation to the asset class, but let at least pension fund managers have the ability to decide on the allocation that they can have. I'll pass here to make sure that we have a debate.
Thank you very much, Eric. Nikolai.
I'm going to be on the exact opposite side of that spectrum, which makes it interesting to listen to for the audience. I work as the CEO of the Copenhagen Stock Exchange, but I'm also responsible for Nasdaq's European equity franchise and also equity derivatives. So obviously financial literacy is something that is very close to my heart. And if we look at the pension system in the Nordic region, I'm gonna double click on Sweden for just 1 second. It actually, the whole mandate of the Pillar 1 system in Sweden is actually on the opposite side of the spectrum of what was just presented. In the pension system under Pillar 1 in Sweden, there's an over-allocation to investments into equity when people are relatively young, up until the age of 55. And the end result is that 10% of all Swedish pension assets are listed in local listed companies. That has built an extremely vibrant listing environment in Sweden. It has ensured that all of the SME companies out there that needs growth capital have had access to capital. It means that pensioners, savers who are now investors have automatically diversified their portfolio. But because they have automatically diversified their portfolio from when they entered the job market, they are also subjected to a high level of financial literacy, because there is an interest to actively say, do I want to choose the default setting, which is, in this particular example, very high allocation to stocks versus fixed income products or alternatives. It brings them into this discussion, and they are inherently well informed and very financially literate, if you will. So fast forward to the Pillar 3 system. The Swedish government, like 20 years ago, they decided to say, all right, we understand that in order to stay competitive on a global scale, we need entrepreneurial society. An entrepreneurial society has an inherent need for capital. We, the government, we, the employer associations, we, members of the industry, we need to support that journey. The banking industry, the advisor industries, we all need to be behind that entire journey. And during that process, they also set up probably the most effective investment savings account structure we have in Europe. I don't want to bring US into the roster, because actually the 401k is that's a pretty effective scheme. But an investment savings account in Sweden is super effective because it's low maintenance, it's super easy to understand. Taxation is the same taxation as freeholding assets, but it's not inventory. Well, it's sort of inventory based. You pay a low annual debit interest on your account balance. So it's super transparent what you're going to pay each year. And in a year where the stock market is up by 20%, you pay a very small proportional interest to the government. But if the stock market is down 10%, then obviously the fixed annual interest or debit interest rate is quite high. But it's easy to maintain, and it's easy to understand, and you don't have to speculate in your tax payments. But it brings me back to the point of saying, if you want the pension system to support not only the capital market union, but entrepreneurship and job creation and welfare creation, the pension system is a brilliant place to start. And whether that needs to happen from an EU policy perspective or on a local policy perspective, I don't want to use the word force, it's a little bit too harsh, but incentivize the pension systems to support entrepreneurship and SMEs, I think that's a brilliant place to start. And if you hear pension asset owners saying, we do that through venture, we do that through private equity, there is some truth to that story, but that venture capital does not necessarily end up in the local country. Does it end up in Europe? Maybe it does, maybe it doesn't. There are also asset owners that are investing in venture funds, and we know what happens with venture capital once they go public. Very often, they move the company, they move the listing to the US, because that's where the original venture capital is arising from.
So I'm going to give, Erik, I'm going to give you an opportunity to respond to this.
Please, because I disagree fundamentally to that description, what you call the story.
Hang on
not
a
story,
minute.
it's reality.
Let me just say one thing, and which I think really is interesting. You talked about the entrepreneurial culture that we need to build that, and that also comes out in the Letta report. And you talked about brave, I think it was José that spoke about brave governments. And I like that word, brave governments, because I think the time has really come to be brave. I think now, and I'll turn to Erik, because, of course, this is, the difference between, the venture capital and private equity market and then the public market. But I think one doesn't exclude the other, and you can build in a stepping system. I think what is important is that you start with where Nikolai says that the Swedish example is, and I'm sure Guillaume and Aleksandra are happy, when we talk about transparency, ease of doing something, building that entrepreneurial culture, all that is building that consciousness. So let me turn it positively, Erik. So the stepping stones, right? You have these stepping stones going from the public to the private markets. But we also want to encourage to have companies staying in Europe, because we do want to grow that European economy. We want to build that single market. So how can we achieve all of that?
Well, first things first, I think there's no actually competition between public markets and private markets, as you somewhat alluded to. I think it's purely complementary. One thing to answer your question is to look basically at the facts. I've seen, and you've seen with me, the various slides showing how public markets have evolved over time, and the lack, actually, of momentum in Europe versus the US. I will just mention one single thing that we've seen in the last 20 years. Private markets have evolved from a cottage industry into a very mature market, which means that essentially players have started to segment the market with a view to be able to accompany entrepreneurs and managers on their growth journey from segment to segment, from venture capital to growth, to more mature development, internationalization, globalization, etc. And it happens that in private markets now, you have players who can actually support the growth journey of a company for a very long time before the managers and entrepreneurs, who are the decision makers, decide to go public, which ultimately they can do, or they can sell, or they can keep and staying private. So this decision does not lie with public markets or with private market operators such as our industry. It lies with the entrepreneurs who are finding value in being accompanied by specialized and professional investors who help them build their business sustainably, grow it over time. Capital markets, public markets can do that too, but what they don't bring is the type of value, type of expertise, type of accompanying support that we bring, including money. But it's not only for money. It's because we are partners. And that's something that capital markets on the public segment can't really provide, which means that you need a certain scale that was, I think, mentioned earlier to go public at one point in time. And there are other considerations, but I won't go into that. So no competition, cooperation over time.
Enrico Letta mentions scaling up companies need to be bigger. We need to have champions. We used to talk in the past always about European champions. Okay, so we do need to scale up those companies. We see that. Otherwise, you know, we're letting ourselves open up to foreign third country companies. But at the same time, we have that challenge in Europe because and probably one of the panelists will know the figure better, but it seems to me about 80% of the companies in Europe or more are SMEs. And of course, what you say with an SME in Germany is very different to an SME in Italy or Spain, for example. So we have a big, big interpretation of SMEs. I'm going to go to Jos because we're hearing sort of, you know, the private and the public markets. We're hearing the challenges for the companies. We need to enhance cross-border investments. We need to establish far more standardization of settlement rules. We need to address liquidity issues. What are you seeing, Jos, at the Dutch level, at the AFM, how that could be brought about? What are the changes you might see?
I think if I start from the perspective of the retail investor that might or might not invest abroad, I think for him or her, what is crucial is cost and trust. And cost means he should have, in my view, a simple, low-cost products that will be sufficient for the large majority of the retail investors. There may be a few who want to do special things, but the large majority should be treated, I think, with low-cost, simple products. And also the issue of trust. And what you don't know, you don't trust. I don't see a Dutch retail investor investing in a Portuguese SME because it's just too far away from him. If you want to, let's say, connect those two, you need to organize it through funds, through collective things. There will not be a direct market, I think, not in the next 10 years for people from one country to invest in individual SME stocks in countries that are more than 2 borders away from them. I don't believe that. So for me, cost and trust are the 2 most important things for retail investors. Another thing that comes closer to my own business, supervision. What is important is that we have a passport system in Europe, so you can enter in one country, get a license, and then do business in all other countries. It means that we have to be sure that in all the 27 countries we are equally strict, or at least strict. Yeah? Strict or stricter, but at least strict. And if that is not the case at the moment, I cannot do much against that. If a firm that sells bad products to my people, the Dutch people, and comes from abroad, I can almost do nothing against that firm. So either we are much more centralized when it comes to giving the license, yeah, so we make sure everyone is equally strict, or you give back some powers to the host supervisor, so he or she can take care of what's going on in his own market. That's another crucial element that also helps to build trust.
I like what you said just now, is either we go one step further or we go back one step. And I think that's an important thing to keep in mind because, you know, and CFA Institute is a global organization. I have a lot of American colleagues. My American colleagues always forget we're not a federal state in Europe, you know, and that this is really a pragmatic issue. You know, we need to build between the local levels and upwardly, but yet we do need to build a European market. Nikolai, responding to Jos. Now, I'll give one other thought for you. I agree with Jos, you know, that it's difficult for someone in Holland to start buying in a Portuguese SME. However, when crowdfunding became fashionable, people didn't hesitate to go and invest in God knows where, in God knows what, even a taxi driver in Lisbon because something was happening, right? So somewhere along the line, I think maybe there is a median way, but what do you think?
I think crowdfunding was a little bit of a meme concept at the time. So I think that a lot of people, they just invested in whatever their neighbor said and whatever some social media influencer would tell them to invest in. I completely agree, by the way, with Jos, that do not expect that any mechanism we can put in place in the world today would incentivize Portuguese people to invest in Finnish derivatives or Finnish stocks. The consolidated tape will definitely not solve that. Is it cheaper to get access to that data? Yes. But will access to data drive that trend? No, I don't think so. It's about getting access to a news feed, which is easily available on your handheld device. It's about taking an interest in a company or in a company's product. And getting access to information about that particular company very easily in the palm of your hand. Will that be possible with ESAP and probably also some AI overlay to ESAP? Yes, absolutely. It will make the financial journalist more equipped to cover not only the local editorial stuff, but also what's going on in other regions of Europe. That being said, I'm still super doubtful that we will see a trend where investors from more than 2 borders away will invest in SMEs. But are there other things that you can do to increase the interest and remove some of the barriers? Yes. Well, language is kind of the first barrier that we need to look at. I think the entire post-trade structure is something that we need to look at, because right now it can be way too burdensome and way too expensive for SMEs to try to attract capital from more than 2 borders away. And then I think there's a legitimate opportunity to applying AI to finding investment opportunities for retail investors. And I think that neo-brokers in the future will make tremendous steps towards that. So if we're thinking about neo-brokers in Europe versus neo-brokers in the US, it's just 2 different worlds. If we look at public.com or Webull or E-Trade or Swap or any of the big neo-brokers, they deliver more than an hour and a half worth of digital educational content to their customer base on a daily basis. So even the neo-brokers in Europe that are doing really well, they still have a long way to go. And if that means that a retail investor based in Portugal gets in from their feed, from their neo-broker, something that's interesting about a new piece of technology in Sweden or a new piece of technology in Ireland, as an example, that would be great. But it's going to take some time before we get there on breaking down the barriers and informing the investors.
Rick, what is your, and a short intervention, because I need to go to the next block of topics.
On this topic, I have no relevant contribution to add. I'd rather discuss at one point in time the fact that we have no more public money available to actually finance the twin transitions, and I think that private markets is part of the solution, and I think that we could do things to actually turbocharge this specific financing mode.
I like the use of the word turbocharge. I think all of us are aware that for this next policy period, we do need to turbocharge. So I'm going to go to Lasse, because he is going to give us some future thinking, out-of-the-box thinking, which I'm very interested to hear at this point in time. Because, Lasse, you sit, of course, in the European Parliament's think tank, so you are seeing sort of, where the interest of MEPs is, how they are looking at things. And, of course, that's sometimes different to what is coming out of the Council and, of course, from the proposals from the Commission, etc. the milestones is important because it's saying, okay, what are we doing? Let's put some meat and let's box it in and let's see how we can compare it. And I think it is important. We need to set ourselves goals. And when we were preparing for this panel, Lasse was reminding me of, 20 odd years ago, how we used to put milestones. Letta referred back to Jacques Delors, and I think he was a great one for putting milestones and, how we can achieve it, these stepping stones that we need to do. Lasse, how can we be more ambitious at the policymaker level?
Yeah, thanks. I don't think I will bring anything new to the table, because I think that's the whole point about Capital Markets Union, that we all know what needs to be done. We just need to do it. And the difficulty is, of course, how are we going about this? Because in many ways, the way I look at or conceptualize Capital Markets Union is, I think it's become a ritual rather than a policy. We have these annual sort of industry get-togethers where everyone says that, yes, it needs to be done, but how do we overcome the blockages? Because the whole difficulty associated with the CMU is that the benefits are huge and spread out wide, whereas the losers are very concentrated and have a lot of political power to block progress. So apart from listening to this panel, which I found fascinating, and thanks for having me, I couldn't help but also look at the room. And I'm sorry for the online viewers, you may not be able to see it, but there's a big red line up there. And I can't help thinking, is the CMU one day going to become this big red line, or is it going to be a small sort of painted line? I think that's the question we need to ask ourselves for the next 5 years. And if you ask for any solutions, now, I don't think there's a silver bullet, and I think several speakers said this, but in terms of methodology, I would subdivide the problem into two different boxes. The first one would be short to medium term, and the second one sort of more long term. And the short to medium term, to me, would really be about supervision, because supervision is a market impact of its own, in a class of its own, whereas, yeah, we need insolvency law, and we need harmonization ideally, and we need progress, harmonization possibly on taxation. But apart from it being very, very difficult, it's also very diffuse politically speaking. So I think the advantage of supervision is that it's something that you can sort of grasp. And looking back at the previous, now outgoing mandate of the European Parliament, one of the things that we did manage, not in the field of capital markets union, but in a related field, anti-money laundering, is we made huge progress on supervision in a related field. And I think what we now look at in terms of supervision is almost kind of a menu of different types of supervisions and different supervisory procedures. Not all of them perhaps as some people would like it. I think this was what José and some other speakers were saying, and I, for once, fully agree with that, and that's also the position of the European Parliament, to see more EU-level supervision, in particular, of course, in relation to ESMA. But I do think that, firstly, there has been political progress on supervision, and that already says a lot, so it is possible to move things. Politics is bricks of Lego that you need to move around, and we managed to move those bricks of Lego in the field of anti-money laundering. The question is, can we use some of these recipes also for CMU in the sense of giving ESMA more supervisory powers? And I would really start with that. It's not a guarantee for success, but I think it's at least a methodology. It's at least a plan, or at least a plan that I would put forward to the panel.
Thank you. And as you were speaking, you were reminding me that one of the things we do see at the EU level is that we can go along quite calmly, like a sort of slow-moving river for a decade or so, and then suddenly there's a crisis. And suddenly you see Europe pulled together now, to the point on the energy crisis, to the point on geopolitical issues on our borders. When you also see neutral member states suddenly getting involved in defense, that's, out of this world almost. So what you're saying is let's be that red, brave lion, and I love that image, I'll make a picture of it. But let's be that brave red lion on supervision. And I'm going to go, of course, to José and Natasha on this point, because can we be brave? How can we do it? I do remember Carmina Di Noia, who used to be a commissioner at CONSOB and is now, of course, at the OECD, saying when there was the review of the ESAs, well, you know, let's just be realistic. Let's realize we have to do it in 2 stages, because I was saying to him, come on, why don't we push this, etc. So let's be realistic. Europe was always built in stages. Okay, so Europe is built in stages. Which stage are we at, Jos?
I cannot tell you at what stage we are. I think that, yes, a lot can be done on supervision. Actually, a lot has been done already on supervision, but as you know, Natasha, we are working very hard on further convergence, and I think the next step would be for certain parts to centralize, and then if you are brave, you do quite a few of these parts, and if you are less brave, you do only one or 2. My biggest point here would be, it's not the only thing. And make sure that this is not the only thing that you do, and so we don't let the politicians get away with only giving a message to us. More needs to be done than just on supervision, and then I come back to my previous point. I think the biggest game changer for CMU would be to have a private funded pension system, and that goes way beyond financial regulation. It goes way beyond the EU level. It needs to be tackled on the national level. It's more a social policy thing maybe than a financial policy thing. So yes, we can do more on supervision. For my part, coming from Netherlands, we are in favor of that. Actually, we were very disappointed then when we discussed about cryptos. We thought that would be an ideal topic to tackle centrally, because no one had already invested in it. There was no legacy, no knowledge, no contact, no systems. But we were very disappointed that we were only joined by one other country who was in favor of doing that in a centralized way. So now we have 27 countries together with ESMA working on this. We have crypto firms who apply for a license in maybe 5 or 6 countries and just wait and see who comes up with the best offer. I think that's not what we should have done, but we did it clearly wrong, a missed opportunity, and I'm sure there will be new chances, so let's take them and also look back, and all the chances that we have missed, maybe we can still correct a few. Thank you.
So, of course, and thank you, Jos, for reminding us that, of course, that pension issue is crucial to unblocking and to stimulating that capital market, but how difficult it is, because it's touching on national rights, national consumer rights, the legality of pensions, its social model, social model, that's really difficult to touch. And yet, the social model is the S in the ESG, and we forget about it all the time. So having had my big bugbear here now, Natasha, you from the perspective of ESMA, so you went to, we had a first reform after the ESAs were established. It was already, I think, quite something to establish ESAs in 2011. That was really quite something. And to achieve two areas of supervision was really interesting, and then you've done a great job. And of course, questions are always asked, how can ESMA grow? How can EBA grow? How can IOPA grow? Can they get bigger? What is their mandate? What are the challenges? Do the boards need to change? What are the issues if you were to achieve more supervision at your level?
Thanks. So let me start by echoing what Jos was saying, because as much as I hear the point on supervision, I also think that will not change the fact that European citizens keep their savings on bank deposits. So we still need to do something, and it can be tailored to member states' realities that can be different, but on taxes and long-term capital. But again, great to hear the support. Let me maybe take a bit of a broader view, because I don't think we are actually the best place to comment on those different discussions, and we'll wait and see where the political balance ends, but maybe to a bit provide more concrete information on what we actually do and how we operate. So first to say, strengthening European supervision generally is one of our key strategic priorities. And what we mean by that is we mean to build a European supervisory culture across member states. And we do that very much with the help of Jos, who is the chair of our senior supervisor forum, so very much driving our convergence work. But we're trying to build a risk-based, data-driven, outcome-focused supervision. So building that culture so that across the member states, the experience in terms of supervision, where we have advanced very much in terms of the single rule book, the actual experience on the ground of how supervision is run is the same. Okay, this is an endeavor, we're working on it in different areas and we have different tools, but just to explain how we look at it. And in that context, we look at the reality. The reality is that most entities in the EU today are supervised, and it's well done so, at national level by national competent authorities. In some cases, we have joint responsibilities between ESMA and national authorities, and in a very limited number of areas, the co-legislators, in all their wisdom, having considered carefully the pros and cons, have decided to entrust ESMA with direct responsibilities in terms of supervision. And I think it's fair to say, as you were saying, Josina, that ESMA has developed a credible stance in terms of its supervision. So just to give one example, our credit rating agency mandate, we are the sole supervisor in the EU. We have global colleges where we sit next to our colleagues from the US SEC, the UK FCA. We engage with the firms, and this is a long-standing mandate we had from the start, and we are credible there. Over time, we've had a number of other areas. The most recent one that has been agreed by the co-legislators looking forward is to entrust us with the supervision of ESG rating providers. So it is still happening that when it is considered that there is added value for EU supervision versus national, new area, similar to existing mandates, it is still happening. So just to share how the thinking goes. And then for all the other mandates where very much we are complementary or we are there more as a facilitator to make sure we reach that goal of the common culture, we act as a coordinator, facilitator of convergence. How that works in practice, we have a very wide array of tools, and there we try to adapt to what the reality is and how we need to foster that convergence. In some cases, we just need to provide some clarifications, so we can put in Jos's committee, we put all the senior supervisors from the 27 national authorities in a room, and we discuss a specific topic, and they can agree this is the right way forward. In other cases, we see that we really need to get our heads around what's going on the market, so we have what we call common supervisory actions. We decide of a topic, and all supervisors go together on that topic. We collect information from the market, and we decide together what are the right steps forward. And then also we have, of course, the peer reviews that everybody is familiar with. But just to share that there are different ways, different models, it's very diverse. And I think you made that point very well, Asa, that actually over time, there are all kinds of different decisions that have been made, and many various models can function, actually, in reality. We just need to be clear collectively in the EU, what is our goal? What are we trying to achieve, and in which areas? And then we can make it work. And the final point is on data, where I couldn't agree more with what Jos was saying. And it's very important to understand that this is one of those areas that is the most demanding. We've had, over time, accumulated many regulations requiring a lot of reporting. And so it is a challenge to avoid the inefficiency of having everybody reporting through different channels with different requirements. So it's very costly for the European system generally. So if we can provide that service, we have put out a data strategy where we want to provide that value, that we can be a hub where we invest on behalf of, we collect the data, and then we give it back to national authorities, of course, but also to the market or to academics, so that that can be also one way of providing that EU added value, hopefully for the greater good of the whole ecosystem.
Thank you, Natasha, and thank you for reminding us about, the supervisory committee where Jos is. And I want to ask you a question, Jos. Have you seen the trust between supervisory and between NCAs increase? Has there been a sort of build-up of communication? I'm sure there are memorandums of understandings as well, but how you also see, for example, that there is, for example, closer collaboration between the AFM and the AMF in France. So there are clusters of closer collaborations. How does that work in this universe?
Yes, you're right. It can work in many different ways. For instance, sometimes we discuss a case, a certain case, and then everyone can learn from each other, inspire each other. maybe sometimes after the meeting you think, okay, I should give him a call because he said something interesting. That's how you start the ball rolling, that people call each other instead of waiting for ESMA to say something. So it's not only ESMA NCA, but also NCA connections that start to improve. But what you also see, and I can only talk from my own experience here, is that if we have, let's say, on a certain firm that does cross-border business, for us it's much easier now to make a call to this NCA and come to a common approach, or not, but then we have to talk again. But at least it's much easier to get in touch with each other because you know that person, you have seen him in meetings. Let's say 5 years ago, only the policy people would have met, but not the people who do the frontline supervision, the people who engage with the firms. And now we have gone quite a big step further.
That's really useful to know. I'm going to turn to the audience. So we've discussed the sort of market structure. We've discussed getting retail investors in, companies involved in this new union. We've discussed building that convergence. Do you have any questions about this? Yes, please. Say your name, and then ask the question, and who you want to ask it to.
Aleksandra Casale from Annemie, Italian Association of Listed Companies. Carmine Di Noia, who you mentioned before, used to work for us, and we still believe that we need to proceed by step by step. And on supervision, we think that we could start giving ESMA some power, supervisory power, on listed companies when listed companies choose ESMA instead of the local, the national authority. This could be one example, or we can give ESMA powers on cross-border situation, for example. The idea is not to get rid of the national competent authorities because they are very useful, but just to change the allocation of the powers. And we think that with a gradual approach of ESMA in the direct supervision, ESMA will have the time also to learn from the national competent authorities and gain some experience on the direct supervision. So we think that there are several ways to proceed going versus the centralization for cross-border situation, etc. And yeah, we think that we need to explore it. Thank you.
Thank you very much for that question. Natasha, do you want to respond to this?
No, again, we will wait and see where the political balance is on this one. I don't think it's for us to comment. But we have heard this idea of the opt-in. There's also this 28th regime in Enrico Letta's report, so we'll have to see. Anecdotally, I think the views are quite split across the market. And again, what I was saying is today the situation is issuers are very much at national level. It's a very core competence for national authorities, the prospectuses, reviewing the disclosures. We would have to see where the balance should land.
Jos, what is your opinion?
I think what you say makes perfect sense, and depending on how quickly you want to move, you make smaller steps or bigger steps, or you make small steps in a very short period of time. But the idea is to take a more gradual approach. I can live with that because I think the crisis is not in supervision. The crisis is somewhere else, as I pointed out a few times already. And there we should not wait, and we should really make a move there. But on supervision, I can live with big steps, but I can also live with smaller steps. But we have to make sure that we try to be efficient as well. And my experience there so far with let's say the EU level is that it's not always about efficiency. So I think there we can improve, and we need to keep each other sharp, I think, in that respect. And I also think if we want to give more powers to ESMA, we should also look at the funding model. Because if you can only do that if you have sufficient funds and that are paid by the people who undergo the supervision. So those two go hand in hand. If we give more powers, we need to take a second look at the funding of ESMA.
Eric, you want to come in?
Yeah, absolutely. I think that opt-in is probably a good idea for the reasons that have been already mentioned, provided, again, that ESMA has the resources, human resources, to get that done. Because, as always, if it's just adding another layer, it's not, I think, relevant from a market's perspective. And it's true that dealing on our end with the 27 different local authorities is complicated. When it comes to marketing our funds, we have also some, let's say, barriers of entry in some markets at a cost which is sometimes fairly different from country to country. So if we have the ability through a mechanism where ESMA can be actually a provider of supervision, if I may, to the market, it can be a good way also to see the market change in terms of dynamics and local authorities, national authorities adapt their way of operating in a way which will be less cumbersome for market participants.
Thank you. Any other questions? Yes, there's a question at the back. Yes, please.
Hi, thank you. Catherine Carlson from Politico. I mean, I'm interested in the political fora where these different discussions are taking place. We've got the Letta report, we've got the Draghi report, we've got a summit going on today and tomorrow. It seems that there are a lot of existential issues around supervision, and those conversations are taking place without much input from the supervisors themselves. So my question for the panel, whoever is interested, is should the ESAs or ESMA in particular have more input into this discussion about its own future?
Who would like to take this?
So Catherine knows. So these are political discussions, and ESMA is a technical body. So, as I said, I think for us at this point in time, it's important that the political discussions take place. We are there to provide any information on how we operate, what we do, what our needs are, what it would mean, to contribute to the debate as much as necessary, but we're not necessarily calling for anything more at this stage, and we're happy again to contribute to whatever discussion is needed.
Lasse, you wanted to come in.
On a related point, I'm obviously not going to comment on ESMA or any other supervisory agency, and I said what I said about supervision, which, by the way, shouldn't belittle the other fields in which, yes, we do need to make progress. But I wanted to say, when it comes to political discussion and who should be plugged into the political discussion, I think one of the key challenges is we need to make sure that the beneficiaries of Capital Markets Union are plugged into that discussion, and that is not yet happening. That reverts back to I guess also the first panel. We need to make sure that the people who are dealing with and who are supposed to be financing the clean tech or energy transition, that they get, if not a say, then at least a sense of urgency and the sense that the Capital Markets Union vitally matters for their policy objectives. I think that's the work that also needs to be done in terms of enlarging the political discussion.
Thank you very much. So we have one last topic that I want to discuss, and I know I have a little bit more time. Thank you, Jella. But I think it's important to turn the circle back to the first panel and to come back to the retail investor and talk about financial literacy. So I always, and Roberto, who's working with me, knows this, I have a triangle in my head: product governance, business conduct, and financial literacy, investor education. There needs to be a balance between them. Sometimes we say, oh, you know, the investors need to be educated, and then everything is going to happen, right? Sometimes we say, oh, no, we need to ban products, that's the way to do it, we use the stick. Sometimes we say, oh, no, we leave it up to the financial industry. Okay, so it's a bit of all of them, I think. But I want to hear and probably start with Nicolai, because that microcosm in the Nordics is, you know, from time to time we get all these conferences in Brussels about the Nordic example. Let's start. Financial literacy, how did that change? You explained a little bit already, but maybe go a little bit deeper into that.
So yes, it did change quite early in Sweden, almost 20 years ago, and the neighboring countries, both Norway and Sweden and Finland, both Denmark, Finland, and Norway have tried to kind of copycat some of the initiatives that the Swedish community have been running with. The most recent example is that Nasdaq has partnered with an organization called the Young Shareholders Association, where we have so far to date educated 1/3 of all high school students in Sweden on financial literacy topics. Understanding your private economy, understanding the basics of investment. Obviously, there's no inducement, there's no recommendation anywhere to be found, but we believe that that is important. We're also partnering with some of the local banks, but honestly, I have to admit, whenever we take those types of initiatives cross-border into some of the other countries, it's a little bit slow. It's a little bit difficult getting the banking associations, the local banking associations, to join forces, because basically what we hear and what they openly admit, all of them, is saying we need the likes of exchange groups or other interested stakeholders to help savers invest the first dollar. That's the most difficult part, getting them to take the first initiative to invest their first dollar, or krona, or euro, whatever it might be. And that's where they can need the support in terms of inspiration. But then when we say, all right, let's see if we can help you. We'd like to educate some of your customers on this particular asset class. No. You have to educate them on how to buy our products. And that is a little bit of a conflict. I understand it, because I think it was Anne-Marie previously who said that 60% of all assets were tracking the incumbent products of the banks, but those were the inherently poorest performing products. That's something I can definitely agree to. But unfortunately, that is where banks are, again, obviously promoting their investors to invest. So I think we have to not only PRIP, KIT, all those mechanisms, they're great, but we are sitting on a gold mine of modern technology to educate the younger generation. And I think that it's not only going to be exchanges, it should also be the banking industry. And basically, it should come with a strong both carrot and stick from government in saying, all right, who is it that actually hold all the financial assets? And the people who hold all the financial assets for retail investors, they should be responsible for educating people on how to manage their money. And they should be responsible for saying, do not expect big government to bail you out when you turn 67. You have to take an active role yourself. And let's start from scratch.
I like this, what you said about it, that enormous step of investing that first dollar or euro. I think it's crucial. It's that mindset. Jos, the Netherlands, the AFM is very strong on looking to its user group. You use behavioral science also, because you look at, for example, selling teams and the way they're structured and the way they have a bias. And I found that quite interesting in combination, of course, with financial education. What is happening in the Netherlands on this issue?
Yes, you're right. We are quite active in that field, and we believe that financial education is fine, but will not do the whole trick. We think that humans are weak. They have their biases. When we talk about pensions, that's something far away. It's when you are old and when you are maybe sick or close to dying. So most people don't like to think about that. And they have a bias for the present. So we think we should help people basically to protect against themselves, their inertia and their their bias. And so we think it would be good to set up and organize a system of financial health checks by some trusted party, where people with certain intervals or maybe at certain life moments are getting a financial health check to see how are you doing, mortgage, study costs for the children, pension, savings, the whole lot, insurance. Basically, are you financially healthy or not? And if not, okay, maybe you want to think about this and this. And I think so then you make people aware and maybe you can activate them as well. But it starts with organizing this for people, because we believe most of us, myself including, by the way, I looked for the first time at my pension statement when I was 50, so way too late to do anything. But fortunately, others had done it for me. So we think that we need to help the people here a little bit. We are also, like was mentioned before, we have in the Netherlands a wiser in money affairs initiative, where the ministry is participating, we are participating, the banks are, insurance are, and we do a lot of financial lessons in schools. I do it every year for many years already, and many of my colleagues in the financial sector do it as well. So that's another way to take your responsibility. And not so long ago, we also have set up a national coalition of financial health, and that really looks at the financial health component, staying out of debt instead of solving debt issues. It's better to stay out of it. And so we are working on that as well. There we have also the private sector, the ministries, the supervisors, and also we have many employers now who offer this kind of financial health check already to their employees. For them, it's not only a cost, because if your employees are financially healthy, they work better, they work longer hours, they have fewer sick hours. So it's good to have happy employees. If you have to spend, I don't know, 200 euros every 5 years for a check, that's money wisely spent.
I think that's actually a really good comment, thinking about the financial health check and how companies need to provide that for their employees, like we have a medical health check for your physical well-being. I think this really is at the heart of the social model of the EU, right? And I think that's, this is what makes the EU a great place, because we do think of the economy, we do think of moving on and entrepreneurship, but we have the underpinning of the social rights. And I think that's really... Natasha, any words on financial literacy and sort of how I know, you've done mystery shopping, you've encouraged that. Any initiatives? I know, of course, it's much more at a national level, but how do you see ESMA wading into this?
I'll be very brief. At first, I really like the idea of the financial health check, because indeed financial education also otherwise is a very, very long-term. We should never neglect it, but a very long-term, difficult project that is very much done at national level. I was going to quote the Belgian initiative here because they are very strong, but the AFM also, and the Dutch experience is very inspiring. So maybe just to add, investor protection is really core to our mission, to what we do, but I wanted to maybe take two angles to try and be on a more positive note. One, to say digitalization could really be an opportunity. We see a huge risk with the young generations that tend to circumvent any of our financial regulations. They don't go through any of the MiFID questionnaires or anything, and they go straight to their crypto apps, and off they go. And it's quite a significant concern. So we could really collectively use it as an opportunity, that these tools are so easy and agile. So we've been advocating for pushing vital information, what we call layering, which is not a very nice word, but to say giving gradual information about what the investor needs so they can actually understand and access a meaningful information so they can make the right investment decision. So that's one way. Of course, we should never forget the non-digital literate, so we should not let them on the side, but still, this could be a very big opportunity to improve and move away from these endless disclosures, as was discussed in the previous panel. The other topic I wanted to think about is we have this huge transition, right, to sustainability. We also, again, here in the young generation have enormous appetite to make a difference, to change, to invest, to contribute to the sustainability transition. So here, a key focus for us is to make sure that we get it right in that context. So focusing, and Jean-Paul Servais touched upon that, how do we prevent greenwashing? So we make sure that the products that are given out there are aligned between the claim and the reality of the product. We are getting there. There's more and more sort of how do you say that, self-discipline within the market. We're seeing that, but we see that also as a financial education challenge. We need to make sure that we capture that willingness to contribute in a meaningful way so that we can provide clarity. So there's a big, probably also effort on here, the policy-making side and the regulators, because with the ambition and the speed at which we have developed this framework, we are facing some kind of heaviness and complexity that we're going to have to take another look at. So I think the Commission is very well aware of that. And the last point I wanted to make is if we want to make sure we get it right in this particular space, given how financial literacy and education takes a while, we really very strongly would like to advocate for consumer testing so that we can make sure and we test whatever we put out there as a new regulation or proposal in terms of disclosure, that we give a chance that we can actually appreciate what the investor actually understands when we put that out there. And I can close on that.
Thank you very much, Natasha. And I want to add my little piece there, because of course, CFA Institute, we represent professionals. And part of the thing we discuss at CFA also is ethics. That's part in the business conduct. And one of the interesting discussions we had at offsite last Friday was when we talk about financial education, if you put the finance professionals, many new entrants into the finance profession haven't done Masters of Finance, where you get taught ethics, but maybe come in from engineering, maybe come in from data, maybe come in from totally different, and we have to open to that because we need diversity of skills in the financial market. So building again that issue of ethics, that everybody understands what it is. When you work in the finance industry, it is not that it spins on itself, but it is there also to underpin the economy. That is going to be a challenge as we go into the new world. I know we probably have overgone time. I apologize, but I thought it was really a great panel. Thank you so much to all of you. It was a lovely discussion. Let's give them a round of applause.
Stay or leave. So, ladies and gentlemen, can you hear me? Yes. I have the special honor to say a few closing words, which is always very hard because it was such a lovely conference this afternoon. So, let me draw close to the end of an inspiring afternoon, as I think. And I would like to extend a heartfelt thank to each of you that you came here and that you actively participated in today's conference. It has truly been an enlightening experience filled with robust discussions and innovative ideas. Okay, thank you. Aimed at breathing new life into the Capital Markets Union, or as we now say, the Savings and Investment Union, the SIU, which I like much better, to be honest, much better than Capital Market Union. First and foremost, my gratitude goes to our esteemed sponsors, whose generous support made this event possible. And I think we really should appreciate that we have such wonderful sponsors. Also, let me say thank you to our distinguished keynote speakers, José Manuel Campa and per video Jean-Paul Servais. And of course, let me thank all these wonderful panelists in your panel and even in the panel before. Let me just say Natasha, Cazenave, Marcel, Haag, just to name few of these very prominent and excellent panelists. I think we are very grateful to your insights, and we are optimistic with regard to the Savings and Investment Union and its future. A special thanks goes to our moderators, Guillaume Prache and Josina Kammerling, for skillfully guiding the discussions. I think you really navigated us through these complex topics, and I think this was invaluable contribution from your side. And also, of course, thank you to you, the attendees, for your presence and for your engagement today. I think it is really very important to revitalize the Savings and Investment Union, as we now say. And I think it should be really a blueprint, the next blueprint for the Parliament. And of course, my special thanks go to Ola Mączyńska, the Managing Director of Better Finance, and the whole team of Better Finance to make this conference possible. So maybe a small applause for them. As we conclude, I would like to invite you to continue the networking on the conversations during the cocktail receptions, as far as I understand. Thank you all for your wonderful contributions. But also, before I close, I would like to take the opportunity and invite you to our next conference. The next event will take place in Vilnius on 30th of May. Here, you see the wonderful QR code already. So there we will discuss the future of finance and European capital markets, touching on fintechs, crypto, with high-level experts and stakeholders from Lithuania, the Baltic region, and all over Europe. So please take the opportunity, go directly on the QR code, register directly, here, you see it behind me, and then you can enter the registration page of the Vilnius event. Our colleague from Vilnius, Guido Stepankos, is sitting here, and I do hope that we will all see us in Vilnius, so please enjoy the rest of the day with a cocktail. Thank you very much.
I will just add a couple of sentences to this. It has really been a pleasure for CFA Institute, representing finance professionals, to partner with financial users. And I think that is the way forward. Going between groups of stakeholders, building that dialogue, building, as Jos Heuvelman said, having the communication between NCAs and not just top-down approach. I think going across sectors and talking to each other is going to be the future. So thank you very much, Guillaume, Aleksandra, Arnaud, and Jella, please, thank you so much for this participation, because I think we're building step by step this capital market. Thank you.
Thank you, Josina.